Tesla stock reacted positively after the first quarter earnings report, despite really terrible results, because investors were really happy with Tesla saying that they're going to introduce a lower cost vehicle probably as early as next year. This is something that investors have been looking for. Tesla talked about a $25,000 vehicle. It's not really clear exactly what the price point is going to be or what the model is going to look like. If it's going to be similar to the Model S and X design that made its way to the 3 and Y. But it is very clear that Tesla continues to go down the cost curve. And this is something that Musk has said that they were going to do long term. But what I think investors need to think about is this the right move for Tesla's profitability long term? At the end of the day, Tesla is a manufacturing company and they need to make money on the manufacturing investments that they've made. The irony of going down market and making a lower cost vehicle is you're going to make less money per vehicle, less profit per vehicle, and you're going to have to make that up in volume. We have seen that Tesla's volumes have actually been the problem in 2023 and 2024. Demand for vehicles that they're making, particularly the 3 and Y, just aren't what they used to be. And that's why sales is on the decline. So is the right way to fix that to introduce an even lower cost vehicle? I'm going to go through some charts and some numbers that hopefully show exactly what's going on at Tesla, because I don't think this is a good trend and I don't think it's the right move for Tesla as a company. They should be staying on the high end and try to refresh their vehicles and lean into the advantages that they already have in the market, not try to outcompete everyone else on price, because that's just not a battle that they're going to win, particularly in China, but even in the US. So that's what I'm going to dig through today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So I'm going to start with this chart that shows the volume of Model S and X deliveries in red, and Model 3 and Y deliveries is the blue column. These are on different axes, so they're not on the same scale. So just want to note that. But you can see that S and X deliveries were increasing until 2017. Guess what happened in 2017? The lower cost Model 3 and Model Y were introduced. I don't think it's any coincidence that 2017 was also when sales of the Model S and Model X peaked. They never reached the same level of sales, and in fact have really dropped dramatically, about 25% overall, despite lowering the sale price of these vehicles over time. Now, if you look at this chart closer, on the blue column, you can see that the deliveries of Model 3 and Model Y vehicles are already starting to decline. Why are those declining? Well, you're seeing more competition in the market. The general design is now over a decade old. So I think the design is getting a little bit old. I don't think there's any indication from Tesla or any other manufacturer that introducing a new lower cost vehicle is not going to cannibalize the sales that you're already making, especially if that vehicle looks essentially the same as the other vehicles. So this is the thing to look at when they do announce the new lower cost vehicles. Does it look fundamentally different? If you're going to charge $25,000 for a certain vehicle and then $35,000 for a Model 3 or a Model Y, that lower cost vehicle better look different so people are willing to pay more money for the higher cost vehicle. And that's not something that they did with the Model 3 and Model Y. I think a lot of us can't really tell the difference between a lot of those vehicles unless you see something like the Model X's back doors open. This is one of the reasons that models look very different when you go from high end to low end, why legacy automakers had different brands. I mean, Toyota makes the Lexus brand. That's effectively the same car in a lot of ways, but Lexus is a higher end vehicle, so it has a very different brand behind it. That has always been the way that automakers differentiated between the high end of the market and the low end of the market. Even if the components were the same, they had different branding because people at the end of the day want to look different than their neighbor. They want to have a cooler, more expensive, maybe even more practical vehicle. And if you're not giving them that, you're just giving them a lower price for basically the same looking vehicle. I don't think that's a successful strategy. The other thing to look at is that Tesla is already starting to make less and less money per vehicle that they produce. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This first chart shows the margin that Tesla makes on each vehicle that it sells. Now, this number peaked in 2022. You might remember that was the middle of the pandemic. There was a supply shortage of vehicles all around the world. Tesla was actually raising prices at that time for all of its vehicles, and therefore margins went up. Margin per vehicle, $15,675 in the first quarter of 2022. Now that was down 2 years later to $7,161. So a drop of over 50% in profit per vehicle. Gross profit needs to cover your operating expenses. It also needs to cover the investment that you're making in manufacturing plants. This is one of the things that manufacturing companies always have a challenge with. If you have to refresh your vehicle and tear out manufacturing equipment, let's say every decade, you have to make not only your money back on the investment that you're making to build out that facility and put that equipment in, but you also have to generate a positive return. So this is what Tesla is dealing with. Their manufacturing equipment, especially in the US, is starting to get a little bit older to the point where it needs to be refreshed. You need to build new molds for new vehicles. There's all kinds of adjustments that need to happen in your manufacturing process, but your margins are starting to go down, and now you're introducing an even lower cost vehicle. So if you're making a $25,000 vehicle and you're generating a 15.9% margin, and that's what they made when you exclude the tax credits in the last quarter, that means that your profit per vehicle is only about $4,000. So now to match the profitability that you had last quarter alone, this is a relatively weak quarter, you're gonna have to make twice as many vehicles. This is really the challenge with going down market. A company like Ferrari can go ahead and say, hey, we're gonna limit the number of vehicles that we're gonna make each year because we're gonna sell each one for $1 million and we're gonna make a $250,000 profit on each vehicle. If you start to go down market and you start to make $5,000 profit per vehicle, now to make that same amount of money, you're gonna have to make 50 vehicles and sell 50 vehicles. That is a huge, huge difference. Now, those are just illustrative numbers, but this is really the challenge that Tesla has and any company has going down market, starting from the high end of the market and then trying to fund lower and lower cost production. We have seen this before in the renewable energy industry, particularly with wind turbines and with solar panels. The cost of both of those products has been declining for decades, and the impact on those manufacturers has been most of them have gone bankrupt. And the reason for that is you build a manufacturing plant based on one set of assumptions, and then suddenly the revenue that you're generating per year starts to go down on a per plant basis. The profit per plant starts to go down. You keep having to invest in the next plant, which goes through the exact same cycle. And so at the end of the day, your profitability really suffers and eventually your balance sheet suffers. Now, Tesla has not run into that problem because they had that excess profitability during the pandemic. But those days are behind us. And that's what I think investors really need to look at is what is this auto business going to look like in the future? Elon Musk really gave it away on the most recent conference call, basically said, this is an artificial intelligence and a robotics company. Ironically, Tesla makes very, very little revenue off of artificial intelligence or robotics. If you look at their financials today, they are an auto manufacturer and an energy company. Both of those businesses are typically very low margin, and the stocks trade for very low price to earnings multiples. That's the challenge that we have with Tesla today. They're trying to go down market, which is very difficult to do and remain profitable. They're in businesses that are very competitive and trade for much lower earnings multiples from a stock market perspective. So now they're trying to transition to this new business model that's very, very unproven. Now, I know a lot of you who are probably watching this video think that that is the future and Tesla is going to actually do it. That's not what I'm getting into in this video. What I want to show here is that it's going to be very, very difficult to remain a profitable auto manufacturer if Tesla is going to continue to go down market and cannibalize the existing vehicles that it's making. Because if it starts making a $25,000 vehicle that looks a lot like the Model 3, guess what? Those Model 3 sales are going to drop just like the Model S sales dropped and just like the Model X sales dropped when the 3 and Y were announced. So I think this is really the challenge that Tesla has making these lower cost vehicles. I know that the market cheered the move, but financially, I think it's going to be a devastating move for the company's income statement. Well, what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.